Okay, let's go ahead and get started. It's a few minutes after 7 here. Just had some connection problems. Yeah, the dogs are they're energized. We got the snow, and the huskies always come in with high energy after they've been out in the snow for a couple hours, and then the corgi has to reassert her dominance, and so that always adds to high adventure. Okay, so let's go ahead and get started then. The executive summary is already posted at the YouTube channel. So if I miss anything in here, you'll be able to see that as well. I'm going to record the whole webinar today. So here we go. So we're looking at the weekly Tortoise 2.0 strategy report for March 3rd, 2013, where you have a market that is still in bullish normal conditions. On an annual basis, it is at the high end of neutral based on weekly RSI 14. And on a short-term basis, using the 10-day NDX, we're at 74 out of 100. So we're also closer to the high end of neutral there. 80 is the criteria that would make it overbought on 10-day. 70 is the criteria on weekly RSI. So we're close to the upper limit of normal in both of those readings. The price relative to the 200-day moving average is green bullish at 8.36%. So that's very strong. The 5-day slope of the 50-day moving average, however, is back to white bullish, so it's backed off a little bit based on this weakness that we've had over the last week. Still bullish, but not as strong as it was before. ADX 14 has also declined to 24.8. Last week it was at 30. 2 weeks ago it was at 35, and both of those were exceptionally strong bullish trends. And so the price decay of this last week has brought ADX down to just under 25. ATR percentage is at 1.01%, which brings it more on the higher end of normal. And then the risk index, which is the VIX, 30-period moving average divided by the 10-period moving average, has a value of 0.91, and anything under 1.0 is risk off, so we're in a risk off condition right now. And then if you take that 0.91 and place that in the context of the last 20 years and assign it a z-score, it has a z-score of minus 1.23, which you see reflected down here on this 30-day time series. So we had a period of exceptional quietude, and then volatility got back to normal. It has been increasing, and now the position of the 10 period compared to the 30 period is such that we're actually at an abnormally volatile condition with respect to those two indicators. So that's sort of a watchword for this long, strong bull market that we've had. There's been enough price decay this past week to suggest that this could be the beginnings of a turning point. We'll see that when we look at price on the market health check. So that's some cautionary signals are being shown right now. In the blended monthly rebalancing, the rebalancing occurred this week. These two are actually crossed. I typed them in the wrong spot. The 26 ETF portfolio is actually this one, Australia, financials, and small caps. And then the 13 ETF is the upper one. That's Australia, small caps, and then Asia less Japan. So I got my wires crossed on that one. Next reevaluation is on or about 1 April. The order of those will be fixed on the next weekly report. In ETF2, the theoretical exposure remains at 100%. The model portfolio is still at 100%, although There were 4 stops hit this week, and that frees up cash. And then, based on the theoretical market or theoretical model, we're allowed to put that money back into the market to work. And so it'll be adding positions in EPHE, which is Philippines, THD, which is Thailand, PSP is a private equity index, and then IYT is the Dow Transports. We'll take a look at those, each one of those charts when we look at swing trade charts. These 2 links to the YouTube channel are 2 particularly good trading lesson videos. I've started to build a prototype Blackboard-based online course. I'm going to start with either the swing trade workshop or just basic technical analysis. It'll allow me to teach online with my trading material the same way that I do for the doctoral seminar, and I think it's going to be hosted at blackboard.com. And it looks pretty powerful, and I think it's going to be a nice way to increase what I can offer in terms of educational material in a structured way. So this looks pretty exciting. I started work on that this weekend. More to follow. All right, looking at the ETF 13 portfolio next. And the top 3, again, Australia, the Russell 2000, and Asia less Japan. Everything is on a buy signal except for the long-term treasuries. You can see the 2 bottom feeders here are Latin America and U.S. tech. And really the NASDAQ is really dragged down by Apple. I don't see that getting fixed anytime soon. So I think the Qs are going to continue to suffer. Although there are some other names within tech that are doing very well, like Hewlett-Packard, United Tech, and Cisco. The Qs themselves are being really held down by Apple. Next in is the 26 ETF portfolio. And that's Australia, financials, small caps. We have China and emerging Europe on cash positions, the BRICS on cash, and then a Swiss franc, emerging market bonds, treasuries, blended commodities, gold, and agriculture all on cash positions as well. Okay, now we're going to look at the market health check. And the vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal purple lines are price targets. That's the top one is a little over 153 and a quarter. That's based on the swing high. And then before that, 151 was the long-term price limit from about the past really 6 months, and which was only recently exceeded by this last little surge up to 153. Horizontal red lines are previous resistance levels that are now support levels, and those become price targets if we see failure. Like if we see the next place that we would see failure would be 149. If it doesn't hold that as a support level, then it would be 147, then 145, and then really all the way down to 140 at the 200-day moving average. So those become price targets or risk levels on the downside based on the length of time that you plan to hold. So on the what I got to see on the upside to get out of this yellow zone is really price that's above 153 and some change. We want to see a close above that. That's the first price that tells us that that we have a resumption potentially of this long bullish move. Black line in the center is the 30-period regression line. The outer black lines are the channel formed by the maximum excursion from the regression line during the look-back period, which happened on Monday's sell-off down here. And then the slope of that regression line is reflected in this curvy black line here, which you can see is now, it was universally up until we saw some of this weakness here, and then certainly this weakness here. Now you can see how that regression line slope indicator is rolling over. It's still positive. It'll remain positive as long as it's above this dotted line right here, which is the zero line for the regression. So as you look at that, what we have is we have about this much room for the slope to still be positive. You know, so if it still continues along this path, it'll stay above the zero line. But it's actually starting to roll over now as we got this big clump of volatility and weakness, and then this smaller one right here. Both of those are contributing to a weakening of the uptrend. What's of concern to me is that the size of the volatility has increased. This one was a relatively small blip, two one-day selling events, and then it resumed. But then this one had some significant sell-off in here. So the size of the, the strength of the bears, if you will, is getting bigger. So that's a concern. If we take a look now here up at the top at the ADX indicator, you can see how really from this point back and coming forward, it's been bulls in charge the whole way until this week. Now there's enough weakness in that price action right there that the ADX line itself is declining, and now you can see there's a little arm wrestling match going on between the bulls and bears right now, slightly favoring the bulls. But it's much weaker than it was even just 20 days ago. Okay. Now we remember that ADX is constructed out of the information of the last 14 days, so that's changing relatively rapidly. It's relatively sensitive. On the positive side, looking at the health check here, we still have price at the top end of the river. That's the dark blue. That's plus or minus 1 standard deviation on a 30-day look back. And then the floodplain is the lighter blue. That's plus or minus 2 standard deviations. When everything was quiet and bull and going well, notice that price was in the floodplain all the way up. And now that a little bit of weakness has crept in, the price is still in the upper half of the river, but it's measurably weaker on a relative basis than that earlier, easier bull. On the positive side, we're still right around the midpoint of the regression channel. So there's no sign of, that is not a sign of panic. We're in the middle of the regression channel. We're at the high end of the river. We're above the Bollinger Band mean. We really have to about 148 or about 3% before we were to really become significant. So really, in my view, 149 is the crucial marker right now. It's the bottom end of the river. It's the bottom of the regression channel. It's a strong support level from Monday's sell-off. And really, for those of you keeping score at home, this sell-off turned out to be a really nice channeling opportunity because an overreaction because it ended up buying here. Now we got a nice, we have this nice trade working. And if we get some white candles in here and get up and test 153, this will look like a brilliant set of entries on those swing trades. So that's sort of the buy on dip side. The truth changes if price goes below 149, however, and then we'd be looking at 147, 145, and then down to 140. And then really right around here is where it gets into sideways market condition. I'm going to scroll down a little bit here so we can look at percent R. Yeah. Now looking at percent R, which Williams percent R, it gave the oversold condition buy signal here on Mondays, and so that's been a nice channeling trade right there. That should have been cashed Friday. The longer term though, the unhealth of the market or the weakness of the market really is signaled by the percent price oscillator. And you notice that actually, it had a crossover way back here and has been warning that there was a potential change in market condition at least that far back. And now with the increased weakness here of the last week, you can see the jaws are open to the downside. Now, Friday was a relatively good close, so this week will tell us whether or not this was a truly buy-on-dip opportunity in retrospect, or the beginning of an intermediate term high. For me, 149 is the tripwire to look out below, but really, if we look back, it's 145. Goes back like 2 months. That's really the last firewall on this bull. If it fails at 145, then we're very close to getting back to the 200-day moving average. It will have invalidated this long, strong bull right here. So that's why this week's price action is going to be pretty important. This how it resolves this tension right in here. It's got to get above 153 this week, I think. Otherwise, the case for the downside starts getting stronger. So that's a look at the market health check. To me, it looks like an aging bull. It's weaker in here than it was the last time it stumbled, but it still has a nice little cushion in here, and there's room for it to catch its wind and go. Like if we saw anything like adult leadership coming out of Washington that would resolve some of the sequester nonsense, the market would respond pretty favorably, I think, because we've seen money flowing to the U.S. away from the emerging markets in Europe. And so it wouldn't take much good news to give a boost through 153 and beyond. Okay, moving on. Next up is the ETFTO Regional report. All 10 of the primary indexes are on a buy signal. And so that creates for this week, a 100% invested and a 0% cash posture going forward. And because there were 4 stops that were hit this week, that allows, money is now available in that model portfolio. We're allowed to put that money to work because the upper limit is 100%. So we can still get that money back to work. So we're in bull normal conditions. The globals are stronger than SPY. Inside the U.S., it's small caps, then mid caps, then large caps, then tech. The 2 strongest sectors remain Europe and Asia less Japan. And the 2 weakest remain technology and Latin America. I've expanded the world market model just a little bit. I've added a few new symbols in here. Thailand, Philippines, Indonesia, and Vietnam. These now have enough price action and enough average daily volume to add them to the mix. And you can see that the Asia less Japan has been pretty strong, and then the real leaders now are Australia and these noobs, the smaller emerging countries in Asia, Thailand, Philippines, Indonesia, and Vietnam. And I've also added up here in the other asset classes the private equity index that's based off of the symbol PSP. So now looking at the U.S., you can see the U.S. is now all above average except for technology. Latin America slightly below average, emerging markets slightly above average, but lagging behind the U.S. In the Western Hemisphere, Mexico and Brazil above average, Canada below. You can see Europe starting to cool off a little bit. This used to be all green except for the UK, and now only Sweden is exceptionally strong, and the remaining European countries are above average, except now the Netherlands has joined the UK in the yellow zone. Still, if you look at the broad European region, still above average, but when you compare that to the U.S., you can now see money's been fleeing over to the U.S. side. Inside the global business sector versus the U.S., now the U.S. is starting to take the lead in a number of the business sectors. Materials are awash, but now it's U.S. energy, finance, industrials, staples, utilities are now in front of their global counterparts, and it's only the discretionary, healthcare, tech, where the globals have the advantage. And even there, it's the advantage is not all that great. So yeah, this has been a slow transition away from the globals back towards the U.S., and that's why I say that if we do get any kind of good news on sequester, that could see a resurgence inside the U.S., and then if so, we want to be looking for the early leaders that are coming out of some of these different areas, and I would think finance and industrials, and then there's some selected tech companies that are doing pretty well, like Hewlett-Packard, that then become attractive. Looking at the ETF top 30, and I've got this sorted now by the strength column, the relative strength column. And I want you to just notice Vietnam, Japan total dividend, Philippines, Thailand, Indonesia, small cap. There's another Indonesian index, IDX. Then Australia. And that tells you about the strength in the smaller, more nimble countries in Asia, less Japan. An alternate way to play that area is EPP, which gives you Asia less Japan, not as strong as these, however, still a pretty robust ETF right now. In fact, it's just off it's like at 65. It's just off the chart here is EPP, but it's drawing its strength from these other countries. Meanwhile, the other thing that's of interest here to me is the Dow Transportation Average, IYT. What I like about it is that it's green on strength and then white on average, and that means that money is flowing into it because the strength column changes first and average only second. And so Indonesia is on the rise. Oil, gas, and equipment services on the rise. Consumer staples on the rise. Energy on the rise. Oil and gas. Internet index. Banks, and so financials. So anything that's green on the strength and white on the average is something that's gaining strength as we go. So you can see where the broad trends are. This is pretty nice right here. The U.S. mid-cap value and U.S. financials are all now starting to appear in the top 30. There was a time, even just a month ago when there weren't any U.S. Regions or sectors on there at all. Inside the Dow 30, using the same lens, Hewlett-Packard remains at number 1, and now it got through the crucial psychological price level of 20. So that's a 100% gain, well, about 85% gain from where it bottomed out around 11.5. And we've watched that thing go from the smallest or the weakest all the way to the very top. So now we'd be looking at some other interesting things, like none of the U.S. Dow 30 is in the red for strength. Now, these numbers come, I put the Dow 30 in that same stack of, that same population of ETFs just to see where the large cap sectors and the large cap companies fall out compared to world opportunities. And it's interesting to note that even the weakest company in the Dow, Merck, and United Health at 51 are still in the yellow. They're not even in the red. So that's sort of a broad-based statement about the relative strength of the U.S. in these mature companies. That's a flight to quality in my view. So I see that as pretty positive. I like the way McDonald's is creeping up here. McDonald's came off the bottom and is now at the midpoint of the Dow 30 stack, and now it's white on strength and yellow on average, so money is continuing to flow into that. Caterpillar and IBM are doing well. Home Depot is doing a pretty good job of holding on. It was all green across the board for the longest, but still holding its place in the top half. J.P. Morgan, Bank of America, and Travelers, so positions 2, 3, and 4 are in financials. And then 3M and United Tech round out the top 6. Disney has made a nice move off the bottom, faster than McDonald's, not quite as fast as Hewlett-Packard, but Disney is showing some real strength too. That used to be all red. So this is a way that you can check week to week on relative strength, and then start getting an idea of what sectors or which large cap companies are attracting more institutional money, and that's sort of a way to frame trades on a swing trade basis using relative strength and sector rotation. All right, moving on. I want to shift over to the Dow. To the daily report now. Stand by while we get that loaded up. Okay, there we go. Sorry about the delay. Let's see. Looking at page 1, summary of systems. No signals in the overreaction or channeling. I want you to notice on the volatility how that goes in waves, and we went through a period of quiet, and now we're back up to, the 6-month average here at 1.01. So we're right in the middle now of normal volatility. I want you to notice on the ADX chart how we're kind of converging back to it's no longer a trending market. We're right at the boundary here of non-trending, with bulls and bears and the ADX all within a pretty tight converged area here. So that's why I see this as a potential critical zone. We have, you can see the risk off indicator as tracking the same increase of volatility that we see over here with ATR percentage. So that just says respect that this is a bull and that this is buy on dip opportunity, but make sure that you are respecting your stops and you are locking in profits. And personally, that means for me that I'm shortening up my time horizon and taking advantage of the shorter term, higher volatility plays, and then not carrying them overnight. That's what I do when I see trending declining, volatility increasing, and moving towards risk off. Inside the pattern trades, we've got a 5-day down in DBC, triple screens in energy and mid caps, 551W in mid caps and Procter & Gamble. And then in the auto framer, we have a number of symbols, typical targets that test out better than 2 to 1. So we have a number of things to choose from on a short-term basis. Looking at the Dow 30, we got Alcoa, United Health, Caterpillar, Bank of America. All are, that's numbers 1 through 4 in the max pain range compression. Alcoa has the advantage of being a doji as well. And I like Alcoa here because it's got 4.4 to 1 reward to risk ratio. Its symbol is highlighted, and that means that Friday's price action was exceptionally weak. So I like Alcoa here at number 1 max pain range compression, a doji, and 4.4 to 1. So we'll take a look at that and frame that as a swing trade. To the same extent, really, United Health, Caterpillar, Bank of America all look pretty favorable. There's just that one 551W in Procter & Gamble, but otherwise no other pattern trades. Inside the ETFs, only 2 dojis, which is Asia less Japan and Treasuries. And then we got a 551W in DBC, the blended commodity. Triple screen here in energy. And then the U.S. mid-caps are giving us a triple screen and a 551W. And then we got some really favorable reward to risks here on the max pain range compressions and the auto framer. And they're all commodities too. Blended commodities, coal, oil, silver, gold, and then Latin America, interestingly, tests out a 2.9 to 1. No pattern associated with it, but on a trade location basis, it looks pretty interesting. I like that, if you're interested in DBC, there's a lot of good reasons to like it. 6.6 to 1 on reward to risk ratio, a 5-day down, a 0 on RSI2 value, and a 3.1 on frog quality number. There's a ton of reasons that DBC is now a very tradable, in a very tradable position, technically speaking. So we'll make sure we take a look at that symbol. Some things to look at here. I want to look at the bottom chart first. Now, when everything was really positive, what I want you to notice on that bull quiet move, all the price action was outside of the river, which is formed. The river is this green and red line. That's the 30-period Bollinger Band, plus or minus 1. And that period of time corresponded to the 30-period regression line slope, bottoming out and then rolling up to get very positive. What I want you to notice on the red line of that regression line slope is notice the nice sine wave that thing produces, and it normally stays in this band between plus or minus 1. It's now right at the upper limit of its 1 standard deviation z-score. So that's where the long-term trend, the 90-day trend, is right there. What that suggests is that in the last time it did that, it went from here to about here. And if you track that, the size of that move is very similar to the size of this move. That's sort of what the S&P can do over a 90-day period, to move from 130 to 145. That's a 10% move the last time it made this move. 10% move. And then this one went from 135 to 150, just about a 10% move. The pullback, when it couldn't go any longer, was about 8%, 145 down to 133. So if we say history doesn't repeat itself, but it does rhyme, then if we say this move corresponds to that move in the regression channel, and then this move looks like that move, we say this, it would not surprise, we would not be allowed to be surprised if it comes back all the way to 145, which would be falling out of the river and protecting. Thus, you got to respect your stops in here and recognize that even on a simple correction in a bull market, it can get back to 145 and still just look like noise on a longer term time frame. So you can't just take a look at things on a shorter term. You got to look at the longer term. And that's what that regression line analysis of the 90 is telling us. All right, so now let's take a look at the 30-day regression line using that same kind of logic. That's the black line. And so it went from a low to a high during this period. So that was a really strong 30-day regression line increase. And the last time it did that, look at that, over the same, really the same kind of time frame. And then when it failed from a +1 z-score down to almost a -2 z-score, in terms of price, that was not as great a pullback, but what that tells us now is this, we could be looking for this. This analysis also gets us to 145. So if you look at just 30-day trends, getting to 145 is not impossible. Now I say all that only just to say, look, if price gets above 153 and goes, that's easy. It'll look really simple to pick the winners and get on them. It's the things that were already long in like an ETF2 or in your other swing trades. The strong sectors are going to keep going. But on a tactical basis, this is very tradable, and I want you to just recognize that 145 is not the end of the world. In fact, if it pulls back to 145 and finds support, that would set the conditions for this kind of move, a third leg up. So 3 steps forward and 2 steps back. So what this regression line analysis tells us on this chart is that I've normalized them all for the plus or minus 1 z-score. That's that normal yellow channel right in here. And it becomes very important to watch what when those regression lines get near that plus and minus 1 level, you can start anticipating sharp changes of direction or a change in the market story. And then it gives you an idea of just how far that big fat thing can move when you look at SPY. Now, the same kind of logic can apply. So this is a form of the slope statistic analysis, and it helps us understand where we are in various market cycles over various time frames. So I hope that that's I spent a little more time on that one because I think this is a moment in the market where this kind of analysis can really help you understand what the possible kinds of moves are. Okay, moving on. We have about another 15 minutes. So I want to get into swing trade charts. Okay, so the first one I want to look at is Alcoa, and this was attractive for a lot of reasons. This was a max pain range compression and a 6.6 to 1 reward to risk ratio, and all that happens because let me try to zoom that in a little bit. Excuse me. Let's see how I do that. Here we go. All right, so we had a nice little doji on Friday, which still held this critical support at 8.4, but it was only a 10-cent range. So that really represents the yellow zone. And then the reason I love this position right here is that if it fails through 8.4, it's quite clearly rejecting this little consolidation zone here, and it's lookout below. And so if I saw Alcoa failing through 8.4 and the U.S. market suffering, then that would be an easy one to get on board because that's already a max pain. It's gone from 9.4 to 8.4. That's an 11% drop over the last 10 days. But conversely, if it holds this level at 8.4 and it's outside the river already, really, we have price targets here at about 8.7, 8.9, 9.1, 9.3, and really we have about a 6R potential trade to the upside. So this is what I define as a critical state in Alcoa. There's a lot of evidence that supports a powerful move in both directions once it gets out of this period of consolidation here. And the level of consolidation, the consolidation zone is small. As soon as it gets out of that fog of war, it's either going to go north quick, and notice how quickly that thing can move in a couple days. Those are the kind of moves that it's capable of on the upside. And by the same token, when it moves sharply on the downside, look at the kind of moves that is capable of. So Alcoa is a stock that moves in both directions vigorously once it gets out of these congestion zones. So I argue right here, this is a perfect congestion zone that is forming a max pain range compression, and when the tension is released, it's going to go strong in either direction, perfectly positioned for a volatility expansion trade. So Alcoa is excellent from that perspective. I want to look at Cliff Natural Resources. And we're going to see that one looks to be about the same idea, but even more so because it had some additional company risk. And so this thing has been great on the downside as a swing trade because we actually have a 1, 2, 3, 4, 5, 6, 7, 8, 9, depending on whether this was a higher, that was just like, it's like 13 out of the last 14 days have been down and lower. And so what that means a couple things. We've got a max pain. On a relative strength basis, when it fell out of this sideways quiet channel, this is the worst performing stock out of the S&P 500 using the stock charts scooters, the SCTR, which is a blend of long, medium, and short-term relative strength measures. So there's a lot of good reasons to be interested in Cliff's Natural Resources. You know, if there's any kind of strength in industrials, then this is going to do well. And it's at the bottom part of its floodplain. It's well below its 200. So everybody that was going to sell this thing has sold it. And what you got now are hardcore long-term holders, I think. So it's gone from 40 to 25. You know, that's a 40% loss in 2 weeks. So that to me just looks like that's the left-hand side of this washout pattern. You know, if this were to be a cup and handle, it would have to get up around 37 for people to buy, or even at 30. I mean, if this thing got up to 30 from here and then had a slight pullback and then took off again, people would be all over that. So what I look at is let's see if we can frame trades between 25 and 30. Because when this thing starts moving, much like Alcoa, it tends to have multi-day momentums. And when it fails big. So it also is, like Alcoa, in what I would call a critical state. And that is where there's a strong case to be made for an upside move. But then if it fails below 25, a strong case for additional painful weakness. And the amount of information that it takes to pick a direction and go is very small compared to a large reward. That's the definition of a low-risk idea in my view that makes this a critical state in Cliff. All right, let's take a look at I have only a few minutes left here, so let's take a look at some of the on the longer term basis, some of the things that got added to ETFTO. So here's just another way that you can use, you know, the reports to kind of get gain some insights and frame some trades, and see how the reports can help you. So I'm going to go down and look at PSP. I wish I had added this to the database a long time ago. I mean, good Lord. This is sort of here's a washout pattern bouncing off the 200 period moving average. Sideways quiet channel entry. Takes out the swing high. Another resumption. The amount that it pulled back this last week is small compared to what the S&P did. And really, if it gets above 11.2 again, there's no reason to believe this thing won't go. This should do well as an alternate asset category. If we see weakness in the broad markets, then PSP is the kind of thing that sort of tracks a hedge fund index and private equity holdings that are relatively less affected by market volatility. So that looks to me like a reasonable longer-term candidate. You can just imagine what the system quality number is on PSP. Okay, let's take a look at Thailand. What's not to love about Thailand? We know there's strength in Asia less Japan. It's not China. You get that same kind of sideways quiet channel emerging from the river, a couple legs up, and it's already back to its triple top high here, and if it gets above that sector, it's going to just keep going. That's what long-term strength looks like. Philippines, excuse me, EPHE. Even easier to see. You don't even really see any correlation to the weakness in the S&P, and that's pretty good. I mean, that's what, if you're a trend follower, you got to like that. And now the last one we'll look at is IYT, the Dow. The Dow 30, or the Dow Transports. One of the stronger sectors comes out of the river and the Iron Cross there when it leaves the 200. A much stronger rebound on Wednesday, Thursday, Friday compared to its sell-off on Monday. So it's already still at its high. And as money flows into the U.S., that's stuff that's being bought and sold, and it's got to be transported. So one of the things we can do is look on the daily report. There is a a quality report on the daily that looks at the leaders inside IYT. So it drills down into the 20 companies that constitute the Dow transports. And it turns out that the Kansas City Southern is a rail company that's very high in that, and I need to investigate my neighbors here in Kansas City. Okay, so we're about an hour into this, and we've looked at a number of very reasonable swing trade candidates. I'm open to your questions. I got a few minutes. We can look at other charts if you're interested, or I can respond to questions. So go ahead and send it. Otherwise, if there's no questions, I'll get this recorded, and I've recorded the whole briefing tonight because I think there were some indicator type. Well, Pete, I just don't believe in the VIX as a swing trading symbol, except the inverse VIX. But that thing is just so darn volatile that, I mean, it'll murder you if you're on the wrong side of that thing. I mean, I'll pull it up and we can take a look at it. But I would just, in my view, you are much better off playing the VIX intraday and not holding any of that overnight, because if you're on the wrong side of that and you get a wild gap, man, you're just one adverse gap on the VIX or the inverse VIX can wipe out 2 weeks worth of trading results in a heartbeat. So I don't see any advantage in holding that thing overnight. The risk is so far out of proportion to the reward, especially when it is so darn volatile intraday, where the reward to risk ratio is tipped in your favor. I can't recommend the VIX as a swing trade. I mean, these kinds of gaps, let me tell you, these kinds of gaps right here, those kinds of days, the intraday is easy to trade, but the size of those gaps will just absolutely murder you. If you were, the only thing I can even suggest, I'm not even going to suggest this, but if you want to bet against human nature, then the one that makes sense to me is XIV, the inverse VIX, and betting against traders. I mean, if we look at let's see how far we can go back on that one. I mean, the one thing, if you were to just look at swing trading much longer term, you know, that's a pretty good chart pattern for betting against volatility. You know, that's a log chart too. So that went from 8 to 24 in an 11-month period. That's a triple. What I like about this current one is that the this recent little uptick in volatility has made XIV go down. And now it's at a price level where, you know, the last 2 times it had a symbol like that, it got ready to do this. And after these, you know, 2 weeks down in a row, it did this. It went from 17 to 24. So to me, when the volatility starts leaving and this train leaves the station, that's a reasonable play. All right, let me take a look at DXY. I'm not sure I know what that symbol is. Yeah, Kendrick, I'm not sure. What is DXY? I don't recognize it. Oh, yeah, I'm not sure. I don't really follow the strength of those. I mean, when I look at, I don't like do the cross between currencies and the U.S. In my view, when there are long-term currency trends, then those end up getting reflected in things like the strength in Japan. Um, but yeah, I'm not sure how to. I would much rather be trading the currency trends directly than trying to cross the streams and move them. Try to interpret what forex means for equity directions. I would rather just trade the technicals on the equities myself. Following the regional ETF flows, that in my view, that's where I think a lot of those longer term cycles between, say, the U.S., Europe, and then Asia less Japan or emerging markets. That's where I think when you have large trends that are accompanied by currency trends, that can bleed over into regional equity trends, and that's where I think you can play it one way or the other, and I think one starts explaining the other. But I think the currency explains more of the regionals than the other way around. But what that means is, I think, as long as you have something like a relative strength trend following system in the regions, you're going to get that currency strength reflected in your positions, because the things that are strong will stay strong because they're being bolstered underneath by that currency trend. So I think that's some of the things we're seeing happening in Japan, and now the cycling of power from Europe over to the U.S. I think is part of that as well. Again, that's just my uninformed opinion, but really, you really don't even need an explanation why the relative strength is working. The fact that it does work or that it is moving is sufficient. It's not necessary to have an explanation. Although, to me, the existence of currency trends helps to explain in some ways the equity trends. I mean, the whole idea behind relative strength investing is to not need an explanation except that it's moving up. So as long as we can find things that have been beaten down so long and are starting to move up, we have the possibility of detecting a state change when those large trends start to reverse themselves. And I think our weekly analysis helps us understand that. Okay, I think I don't see any other questions, so I'll go ahead and shut her down here and get this thing processed. And I will upload the entire video there at the YouTube channel later this evening. So thanks for your attention and good trading. We'll see you in the chat room.